Happy Monday, everyone. Welcome to the Monday Market Update. My name is Nash Paradise, and joined here with me as frequently as I can get him, Mr. Andrew Cady, branch leader out of Florida. Andrew, how was your weekend, man?
Amazing weekend. Thanksgiving weekend, a lot of time with family, a lot of time of relaxation and chill. Couldn't have asked for a better weekend.
Love the chill and like to hear that. Let's talk about what happened last week in the world of not turkey and stuffing. It's a whole lot of not much. Low volatility last week. It was a holiday week. Not a lot of trading, not a lot of data. Nothing real crazy going on. We did have a nice slide on the overnight average for the 30-year fixed, starting the week at 6.32% and finishing out at that 6.22. Let's break down how we got there. If you want to jump into the nerd stuff, basically we got the PPI index, retail sales. There was a few bit of data points that jumped out. I found the ADP employment change interesting. That was a little lighter than expectations. Nothing really seemed to have a strong effect on the market last week, though. Not a lot of movement, and like I said, low volatility index. So not mad about that. Speaking of low volatility index, Andrew, what do we got going on this week?
So this week, we've actually got more data coming out. And it's funny because today should be the day we really don't have much for volatility. But we have, our meter is already off of low for the day. Our meter, I would say, is moderate volatility this morning. And it just proves how interconnected our world, our global markets really are. So we woke up this morning we've lost about 20 basis points in mortgage-backed security pricing. 10-year Treasury jumped from 4% to at one point almost 4.1. So 10 basis points up, massive shift. Why? Well, it was on the news that our equivalent of the Fed chair in Japan announced that they may be doing a rate hike, and Japanese bonds have sold off over it, and it's just interconnected with global. So our bonds are equally reacting to it. But this week, we do have some market moving data. So even though we're starting the week a little bit more volatile already, I do expect we could continue to see that change. I think the biggest data we have, really, there's two big pieces. Is Wednesday, we have the ADP payroll. And this is one where they're only expecting 10,000 job creations. So this is a massive drop off from where we were. Previously it was 40,000. They're only expecting 10,000 job creations. And if we miss that into a negative job print, we could really find the markets bettering themselves. And then you have initial jobless claims coming in on Thursday, could bring some volatility to it. But really Friday is going to be the day where we got to watch the volatility. We have our wonderful measure, the Fed's favorite measure of inflation, the personal consumption expenditures. This is what does it cost to live? We get that out at 7:30 a.m. And then we're going to obviously have, all the stuff that comes with that, the core, the full reading. So this week, expect some volatility. We hope that the ADP numbers come out in line and we potentially see a little bit of a betterment towards mortgage rates. Nash, you want to add anything to that?
Yeah, I would just echo that. We definitely have a moderate volatility week with interesting stuff coming in, Wednesday and Friday. I feel like that $10,000 or that 10,000 job added mark from ADP has a lot of room to hurt us. We come in at 30, 40,000. It's not that significant, especially compared to the fact that we had 42,000 last month. but missing on that is a significant miss. So I do think that could turn things negatively. Like you said, right now we're dealing with all this from Japan. We need our own data and our own stuff to move. But the fact that the 10-year bond has moved, 69 hundredths right now, I'm like, that's a lot of movement for not a lot going on. But like you said, we're all connected. So let's see where we're going with the Fed right now. I know this has been a hot topic for us on whether or not we're getting a 12-10 cut. And based on the movement this morning, you'd think that this would be shifting in a different direction than where it's going. But we're getting more likely. So we're getting a lot closer to me being right. How does it make you feel?
Hey, listen, I still maintain my position. I still think the Fed has teed up for a pause. And I'm saddened by this chart because if the Fed does follow through with a pause on what I think they have pretty vocally, what Powell set out in the last meeting, the Fed meeting minutes really backed it up. If the markets are predicting a cut and we don't get one, we can see, and that's where we'll have an extreme volatility meter. But I don't know. I still think the Fed teed it up, and if they've been one thing that's consistent is the message they put out, they tend to follow through with. The Fed tends to choreograph their moves now. They tend to not let the markets be shocked, but markets are reading it as almost a 90% cut. So I guess Nash might be right.
Oh wow, could you let my wife know, because that doesn't happen very often. I'll take that. Let's take a look at what happened with mortgage rates. This looks a little more severe than it is. We've talked a lot about rates getting better as we get closer to a Fed meeting, and that's been fairly consistent when you look at a long enough chart. Obviously, last week was a slight improvement after we had jumped back up. We've been hugging this 6.25 range for a while now, and I think that's been a nice, safe spot to plant. It usually has the 10-year treasury somewhere around that 4.05 mark, which puts us in this 2.1, 2.15 spread between them, which has been holding steady for a bit. There's a little uptick there this morning, but like I said, I don't think it's anything that's super severe or worth paying too much attention here going forward. Anything else you'd add to that?
No, I think, looking at the charts today, and obviously I don't have the screen grab to put on, but we have two really strong supports, not only in mortgage-backed securities, but in the 10-year treasury right now, that they've held. They got broken at one point. They've held pretty consistently today. We've got the 25-day moving average and the 50-day moving average as ceilings before we would get worse on mortgage-backed securities and the 10-year. And those really need to hold. If we would break above, really call it 408 on the 10-year treasury, that's where the 50-day moving average is sitting at. If we convincingly break above that, we could see 412 as the next stopping point on the 10-year. And if we would convincingly break below the 50-day moving average on mortgage-backed securities, that's where it could get ugly, because there is zero support all the way down for another 47 basis point worsening in rates. So we really need that 25 and 50-day moving average to hold on the mortgage-backed security front, or we could be in for some pain this week. And like you said, the bar is set really, really low on Wednesday at 10,000 job creations. It's not hard to see 21,000, which is a horrible print. That's a horrible amount of job creations for a country as big as ours, 21,000 job creations. But if we overshoot a 10,000 estimate, we may go from a low volatility week to a extreme volatility week, just seeing what the data comes out at.
Yeah. Andrew Katie says, hold the damn line, because we are already at that 488 mark on the 10-year treasury. So, and we've blown through 408. I would say that 410 is probably the mark that we need to stay away from, looking at the moving averages. I feel like we'll get some resistance there. We've had a little resistance there so far today, but like you said, mortgage-backed securities, the 25-day and the 50-day moving average is almost exactly where we are right now. So we're in this holding point, this holding zone. That 50-day average is going to come up sooner than later, because 60 days ago things were a lot worse than they are now. Anything that you're seeing that's going to change up how mortgage originators and real estate salespeople are going to be functioning through the end of the year, as it relates to knowing a Fed meeting is coming up with a likely drop, as far as I think? But regardless, with the lack of data until the middle of the month, we are getting a lot of data after the Fed has their meeting. So are you anticipating a normal December that we typically have middle moderate movement, or are we set up for a lot of wild activity as we get to mid-month?
I think I think as we get towards mid-month, we're going to get a lot of the data that should have come out during the shutdown. And to me, current data is the market mover, but hindsight data can also really move markets because the market moved already based upon what it assumed. And if that assumed data comes out different as we start to get that data out in December, we could have an extremely volatile month. But going back to what you said, because my mind went a totally different place when you said, what are loan originators and real estate agents? Most of them are not working. Most of them have taken their car out of drive and put it in neutral and have begun to slowly apply the brakes as they head into the holiday season. They're starting their eggnog traditions today. And I would just challenge anyone in real estate or mortgage. You are in the most opportune time right now through the end of the year to take market share away from those who are coasting. So what they should be doing is doubling down on activities, tripling down on activities, and not letting anything go by the wayside.
I like how you said put it in neutral and hit the brakes and really just showed your age. Like there's a whole lot of people watching this who are like 26 years old and they're like, wait, when would you put your car in neutral? Andrew Cady over here is driving a 6-speed 1978 pickup still. Yeah, we know how you grew up. You just showed what you've gone through. But yeah, I'm with you.
I actually had a really fast 6-speed car is what I was referencing.
Fair enough. And timing is good because it looks like my video has just decided to glitch out and our internet here is shaky. But to sum up what we got going on, moderate, mid volatility week, some interesting things coming out, especially later in the week. We'll have to take it by ear and see as we get closer to that December 10th meeting, what's the market going to do? Are we going to be reacting to Japan overseas? Is our own data going to step up and move the needle? We will be back next Monday and we'll break down what happened and get you a plan going forward.
Take care, guys.
Thank you.